The economy of China is developing fast. So fast, in fact, that its currency's share of global trade finance has now overtaken the euro share. This is a massive milestone to show just how much influence China is starting to have on the rest of the world, and it's unlikely to stop there. The economic expansion is predicted to continue, and at this rate, the yuan is likely to become one of the biggest financial players on the world stage, alongside the dollar. But how did it get to this point? Back in the 1970s, China's economy was on a third world level. No one could anticipate the massive growth that we've all seen. A big part of this was significant market reforms brought on by a change of leadership. But an important piece of this puzzle was the massive amount spent on domestic and international infrastructure. This investment allowed China to be cemented as the world's factory and become the biggest exporter of goods on the planet. In this video, we're going to see the strategies that led China to become such a massive influence on the world's economy, to the point where it's now stronger than the euro and closing in fast on other currencies that have been dominating the world stage for a century and beyond. It's a story that has happened incredibly quickly, but one that's been orchestrated deliberately to exploit the massive amount of resources the nation has. After such rapid growth, they're on the cusp of something truly influential when it comes to global economics. As of 2023, the renminbi, China's currency, accounted for nearly 6% of trade settlement, almost tripling the same stat in September 2020. This has helped to overtake the euro's share of 5.3% respectively. Since 1978, China has had a policy of transition from a centrally planned to a market-based economy, twinned with an open-door policy that has involved substantial loosening of its international trade and investment operations. This strategy has given consistent and high economic growth, averaging around 10% annually between 1978 to 2008. This has seen GDP per capita increase 15 times, from around $220 to $3,400. That being said, China's dependence on export-led growth did lead to a decline in its growth rates after 2008 due to a fall in external demand because of the global economic crisis. But unlike other World Trade Organization members, China doubled down and maintained its long-term strategy of opening up its economy to international trade and foreign investment. The Chinese government responded to the financial crisis with a large economic stimulus package, 14% of GDP in 2006, designed to boost domestic demand by investing in public services to help sustain economic growth. But it's not only their own infrastructure that China has been interested in. Now it's buying up other developing nations as part of an interesting initiative. China's massive economic growth and increased competitiveness has been underpinned by a huge development of infrastructure, particularly in the 90s. But the biggest infrastructure project on Earth, China's Belt and Road Initiative, is all about other nations and boosting their offerings. The principle of going big with this has led to an airport in Pakistan, a high-speed train line in Indonesia, a port in Ethiopia, and Africa's longest suspension bridge in Mozambique. Between 2013 and 2021, China provided at least $331 billion in financing to an array of countries, mainly in the Southern Hemisphere. African countries alone have received $91 billion. This has helped China build ties with countries it didn't have relationships before, and in return, it provides this infrastructure. The project's outlays have boosted economic growth in many developing nations. It's helped foster global self-led institutions by providing financing, opening energy access, and removing infrastructure bottlenecks. But this is not purely a selfless project. The initiative is also seen as a way for China to expand its global economic and political power and give new markets and profitable projects for Chinese companies. This development also comes in the form of loans, and these need to be paid back. It's played a big role in expanding debt in the global south, as well as promoting fossil fuel use and trampling sensitive ecosystems. Sometimes the project has been called the New Silk Road, in reference to the last time China was a production powerhouse. Launched in 2013 by President Xi Jinping, the vast collection of development and infrastructure initiatives was originally devised to link East Asia and Europe through physical infrastructure. President Xi's vision was to create a vast network of railways, energy pipelines, highways, and streamlined border crossings, both westward through the mountainous former Soviet republics and also southward to Pakistan, India, and the rest of Southeast Asia. This is to expand the international use of Chinese currency and break the bottleneck in Asian connectivity, according to Xi. On top of the physical infrastructure, China has also funded hundreds of special economic zones, or industrial areas designed to create jobs, and promoted countries to use its tech offerings. such as the 5G network powered by the massive telecoms company Huawei. There have also been plans for a 21st century maritime Silk Road to accommodate expanding maritime trade traffic. This involves China investing in port development along the Indian Ocean, from Southeast Asia all the way to East Africa and parts of Europe. China's overall ambition for this initiative is huge. To date, 147 countries, counting for 2/3 of the world's population and 40% of global GDP, have signed on to projects or expressed a desire to. Analysts estimate the largest project within the initiative to be the estimated $62 billion China-Pakistan Economic Corridor, a collection of projects connecting China to Pakistan's Gwadar port on the Arabian Sea. China has already spent an estimated $1 trillion on efforts on this in total. Experts think that the initiative may cost up to $8 trillion. Experts see the Belt and Road Initiative as one of the main pillars of a bolder Chinese statecraft under Xi, alongside the high-tech Made in China 2025 economic development strategy. The BRI serves as a way for China to develop new trade linkages, cultivate export markets, boost Chinese incomes, and export China's extra productive capacity. It's a way of putting themselves at the center of global trade and not the US or Europe. The initiative also follows the fact that China is motivated to boost global economic links to its western regions, which in the past have been neglected. Promoting economic development in the western province of Zhejiang, where separatist violence has been on the upswing, is a big priority, as well as securing long-term energy supplies from Central Asia and the Middle East. Also, another significant and slightly more sinister reason for this expansion is that Beijing could seek geopolitical leverage over the countries it's seemingly helping. China also frequently retains the right to demand repayment at any time, giving Beijing the ability to use funding as a tool to enforce Chinese hot topic issues such as Taiwan or the treatment of Muslims. Other nations are resistant to the initiative for these and similar reasons. India has tried to convince countries that this is all a plan to dominate Asia, warning of what some have called a string of pearls geoeconomic strategy, where China creates unsustainable debt burdens for its Indian Ocean neighbours to take control of regional choke points. In particular, India has been concerned by China's decades-long embrace of its traditional rival, Pakistan, for a long time now. Meanwhile, India has started a similar approach to its rival and provided its own development assistance to neighbours, most notably Afghanistan, where it spent $3 billion on infrastructure projects. Japan has a similar strategy to India's, balancing its interest in regional infrastructure development with suspicions about China's intentions. The country has pledged over $300 billion in public and private financing to infrastructure projects throughout Asia. With India, Japan has also agreed to cultivate the Asia-Africa Growth Corridor, which is a plan to develop and connect ports from Myanmar to East Africa. That being said, very little progress has been made on this since 2017. And all of this has helped China to become a global trade hub bigger than that of the euro. Remember, usage in trade finance has tripled in the last 3 years and is accelerating. China's digital innovation and the expansion of digital trade finance products are essential drivers for the accelerated use of their currency. Despite an economic slowdown, China's demand for commodities remains high and will continue to underpin RMB-denominated financing. The weakness of the yuan is unlikely to disrupt the long-term expansion of RMB usage in trade finance. For China, the growing share of yuan in global financing ticks one of its main internationalization priorities. Latest assessments suggest that the RMB will continue to exceed the euro's share in future years. The extent of the gap will depend on global economic and financial market stability, but it could be over 3 percentage points in a few months' time. Only time will tell, but it looks like the yuan, bolstered by strategy laid out with global infrastructure projects, is not going away anytime soon. For more videos on the most important topics from the world of economics, please subscribe to Tree's Economy. Thanks for watching.